The OECD released new economic projections for this year and next year. They expect overall economic growth on a real basis, net of inflation. The monetary value of what is produced will be 2.9% in 2025, down from 3.2% in their previous forecast. Their forecast for next year is the same at 2.9%. What's interesting, though, is what's going on in the underlying countries. Let's take a look at a chart from the OECD report. The fastest growth continues to be India at over 6%, followed by a number of other emerging market countries. Europe is expected to increase growth from last year, but the U.S. is expected to grow their economy 1.8% this year, 1.5% next year. The reason they're expecting slower U.S. economic growth is the tariffs. With an effective tariff rate of 19.3%, that will impact economic growth, according to the OECD, as well as lower net immigration into the U.S., so fewer workers coming from overseas. Now, of course, these are just projections. We don't know what will happen, but when we think about, well, here's what the expectation is, and here's its impact on corporate profit growth, what are investors paying for that future economic growth, the future corporate profit growth? In the U.S., it is demonstrably higher than it is outside of the U.S., which means the U.S. stock market is priced more for perfection. Let's take a look at how expensive the U.S. is relative to non-U.S. stocks. For that, we can use AssetCamp, our research tool for financial advisors and high net worth investors. The global stock market, including emerging markets, but excluding U.S., is priced at 14.6 times forward earnings, about one standard deviation more expensive than average, whereas the U.S. stock market is at 22.8 times earnings, 2 standard deviations more expensive than average. If we look at valuations based on trailing earnings, non-U.S. stocks are cheaper than their long-term average, while U.S. is about 1.6 standard deviations more expensive than average. The U.S. stock market is more expensive than average. Now, given the lower economic projections, the impact of the tariffs, is a prudent time to perhaps rebalance away from U.S., allocate some of those profits to non-U.S. stocks. What do you think? Should we put any merit in economic projections from the OECD and other economists?